The United States government is spending $7.23 billion today. Not on defense, not on Social Security, not on roads or schools or anything you can see. Just on interest. On money it already borrowed. And tomorrow it will do it again. The U.S. national debt crossed $39 trillion on March 17, 2026. Not $36 trillion, which is the figure this channel covered in a previous video. The debt hit $38 trillion just 5 months ago, and $37 trillion 2 months before that. The pace is accelerating. At the current rate, the United States is adding $7.23 billion in debt every single day. At the same time, oil is trading above $100 per barrel following the closure of the Strait of Hormuz, the waterway through which 20% of the world's oil moves. The Federal Reserve held rates unchanged this week, and its chair told reporters, this is a direct quote, "Nobody knows." A $3 trillion private lending system sitting inside millions of American retirement accounts is restricting withdrawals. The jobs market lost 92,000 positions in February alone, and the government is spending $2 trillion more than it collects every single year, with no structural mechanism in place to change that. The U.S. economy has not collapsed. This video explains why, and what the system is doing right now to hold itself together. The reason the economy has not collapsed is not strength, it is not good policy, it is not a strong job market. It is the same reason a tower of cards does not fall until one card shifts. The question is, which card is shifting right now? To understand why the current pressures matter as much as they do, you need one concept: leverage. Leverage means using borrowed money to do more than your own capital allows. Most American households are leveraged: mortgages, auto loans, credit cards. The banks that issued those loans are leveraged. The private funds that packaged those loans are leveraged. The pension systems and insurance companies that invest in those funds are leveraged. And above all of it, the federal government carries $39 trillion in debt, the most leveraged institution in the entire system. In 2008, the entire global financial system was destabilized not by a majority of mortgage loans failing, but by 4.5% of one category of loans going bad. That is what a fully leveraged, fully interconnected system does. It does not absorb the shock. It transmits it through every connected layer until institutions that had nothing to do with the original problem begin to fail. The system today is more leveraged than the one that existed in 2008. There is $10 trillion sitting in American 401k accounts. A portion of that money found its way into what is called the private credit market, funds run by Blackstone, Apollo, Blue Owl, and others, which raised capital from pension systems and retirement accounts and lent it to private companies at high interest rates with almost no regulatory oversight. That market grew from near zero to $3 trillion in under 10 years. Now investors are asking for their money back. In the first quarter of 2026 alone, Blackstone's credit fund received $3.8 billion in redemption requests, a record. Blackstone had to use its own money and its employees' personal funds to cover the gap. Blue Owl halted redemptions entirely. BlackRock began limiting withdrawals. Combined, these firms have lost $265 billion in market capitalization since September 2025. Most of the people whose retirement money sits inside these funds have no idea this is happening. When private credit dries up, businesses cannot refinance. They cut people, consumer spending falls, tax revenues fall, and the government that is already spending $2 trillion more than it collects every year faces that shortfall with even less to work with. On February 28th, the Strait of Hormuz closed. Brent crude crossed $100. Gas prices rose 32% in under 3 weeks, from $2.92 per gallon on February 26th to $3.84 by March 18th. The average American household is now on track to pay $740 more for gasoline this year than last. Every major U.S. recession since 1973 was preceded by an oil spike, and in every previous case, the Federal Reserve had room to cut rates to cushion the blow. Today, it does not. If the Fed cuts rates while oil is above $100, it risks reigniting the inflation it spent 2 years fighting. If it holds or raises rates to fight oil-driven inflation, it risks accelerating the contraction already visible in the jobs market. The Fed can defend employment, or it can defend price stability. Defending both simultaneously is the same configuration that produced stagflation in the 1970s. The fiscal math leaves almost no room to maneuver. The federal government collects $5.2 trillion in annual tax revenue. Entitlement payments consume 70%. Interest on the debt consumes another 30 cents of every dollar collected, already surpassing defense spending in the first 3 months of this fiscal year alone. Those two categories together already equal 100% of federal revenue. Everything else is borrowed. If revenues fall even modestly through recession, through job displacement, through a contraction in corporate profits, the government cannot cover its legal obligations without printing money at a scale that carries its own structural consequences. There is one theory institutional economists are quietly discussing. The U.S. government holds 8,133 metric tons of gold, valued on its balance sheet at $42.22 per ounce. That price has not been updated since 1973. Gold is trading at approximately $4,500 per ounce today. A mark-to-market revaluation requiring no new borrowing, no new taxes, no legislative approval would add over $1 trillion to the government's balance sheet overnight. Roosevelt did it in 1934. Nixon did it twice. Each time it was used when other options were exhausted. Whether it happens now is unknown. What is known is this. Jerome Powell stood at the Federal Reserve's podium on March 18, 2026, and told the world nobody knows. Not because the data is inaccessible, because the configuration of simultaneous pressures the U.S. economy is carrying right now is genuinely unusual. The system is functioning. The pressures are measurable. The question the data is asking, quietly, inside the numbers, is not whether the U.S. economy can handle any one of these challenges. It is whether it can handle them all at the same time.